Hey, everybody. Welcome to the second anniversary of doing these crazy weekly webinars. Oh, my goodness. So yes, it's St. Patrick's Day. It's our 102nd week anniversary and the second anniversary. So Jack Shamrock Santaniello is somewhere in Disney World. So he is skipping out on us. And he was not present for the first few weeks with us anyway. He was evidently on the line, but he was not one of the panelists. So today he's, drinking green beer, wearing a leprechaun outfit at the Magic Kingdom, evidently. So, and Adam is skiing with his family, and he joined us because he knew that I couldn't answer your questions, and at least intelligently. So he's going to hit the slopes as soon as we're done here. So thank you for joining us. He is in the I don't know what you call it, the Star Bridge.
Gary, you got to get with the program. It's either
I was
seeing
never
the
a
background.
Trekkie.
Yeah, it's either seeing the background of the original series Enterprise, or you can see a really crappy hotel room. So I thought this would be a better option for you. But it is kind of
great.
It is kind of funny commentary around the whole working remotely thing in terms of taking advantage of a 2-hour time zone change. So got up at 5 o'clock time here, but it's 7 o'clock time East Coast, and got a bunch of stuff done, and then I can take a little window of time and then hop back on and wrap up everything for the day, since I don't have a lot of people that I have to talk to outside of this webinar today. So just as much as we talked about team building and culture, and you got to get people back together for trust building and innovation, all of that is true. And at the same time, this is the other side of the equation in terms of going with the concept of balance in your life is created. It's not something that you just find somewhere. I mean, you got to search for it and actually create it for yourself. So this is just the other side of it, which when we think about BGW, we still want to give everybody in the company the opportunity to do stuff like this, and still meet the needs of our clients. So with that, I will shut up. I got a little green in the shirt, and I see you wearing green too, Gary.
Yeah, absolutely. Cleveland City Stars, we lasted for a few years, but we did actually win the USL championship. I was on the board, and so they gave me my own jersey, which was fun.
There you go.
I decided not to wear my green and white wig today for y'all, but I do have it. Hey, also, real quick question, or real quick notice, if anybody didn't notice, so the Senate it's good to know that our elected officials can agree on one thing: time zone change. So evidently we're going to have daylight savings time permanent, but we got to go through another gyration next year because Amtrak and all the airlines and whatever, their schedules are already set evidently for in the fall. So nonetheless, it's good to know that our elected officials are hard at work declaring that daylight savings time is going to be in effect forever until they change their mind. One other thing that I thought we'd talk about before we go into a poll. So we've got some more of the top 100 poll questions, and we'll launch that for you guys. But what was interesting is, on culture, I was talking to a friend of mine that they have been virtual, and they've got about 100 and some employees, and they've always been virtual. They're a software as a service company. And we've been asking people, like, how do you maintain culture in a remote environment? Well, one thing, it's a little bit easier, I suppose, if you started out 100% remote. But there are some things that he told us that I thought were really interesting. One was the number one thing: hire for culture. And and one of their core values was what was it? It was like, find a way. something like that. I don't remember what the deal was, but they're really big on teamwork and that sort of thing. And so they hire appropriately. They let people know, hey, you're going to have to kind of come with batteries. You got to be a self-starter, and we want you to engage. But another thing that they do is they meet quarterly. Everybody flies in together, and they have a couple days together. So that's one way that they do it. And then they also have Slack channels where they have, a water cooler kind of talk. They have kind of a celebrations thing where they're doing shout outs for one another, that, recognize and reward, if you will, but recognizing really behavior that fits their core values, which I thought was really good. And then they have kind of a tone from the top, if you will, channel from the leadership team that's their communication module. So a few good tidbits that I thought were kind of worth looking at, because quite frankly, we're probably going to be in a hybrid environment for a while. So anyway, anything you want to add to that before I launch polls, Adam?
No, it might have said it in a previous webinar, is that, when you come back to the team building, the gurus in the gurus of culture, which, at the end of the day, there's a few of them, but two that we listen to are Patrick Lencioni and Simon Sinek, have both kind of given up on, you can create innovation and trust in a virtual environment. So I think what we're finding in our own exploration of virtual teams and 100% virtual is there's still a lot of live one-on-one stuff that occurs, because nobody's mastered the, how do you build trust virtually? Even if it's live, more intentional one-on-one Teams meetings, and if you got to have innovation that's going to happen, brainstorming, you don't do that over Zoom. You bring everybody together for that. So it's a long way of saying that, I think the answer is, people got to be together in some capacity, even if you don't have an office. So that's all.
Yeah, that's good. All right, so I'm going to go ahead and launch a poll. Last week, we talked a little bit finding cash in balance sheet, I think, but we didn't go into finding cash in your P&L. So I'm going to go ahead and launch this poll. If you guys would vote for whichever question you'd like to have Adam pontificate on. So if you would find your poll button. There we go. Managing overhead costs. So far, we got some action there. Keep rolling. Benchmarking, budgeting, forecasting. You guys are on it. This is good.
I can't see the results, so you're going to have to help me out here, Gary.
Yeah. So what I'm going to do is I'm going to go ahead and share the results with y'all. Can you see it now?
All right. Yep. Got it.
All right.
Okay.
Cool.
We can do this. All right. So let's start off with, I think we can probably nail all three of these, which is timely because we just trained our internal team about this on Monday. So benchmarking, budgeting, and forecast. We're going to start there because they're all somewhat related in some respects. So, oftentimes we get asked, how am I doing relative to my peers? How can I make more money? Stuff like that. And I think, the first thing to think about when it comes to benchmarking is there's really, two ends of the spectrum of benchmarking. Most benchmarking data that you can get that's available to you, remember, is just an average. It means you're middle of the pack. That's what you are. That's the benchmark, is what does it take to be at the average? And some of them throw out the highs, some of them throw out the lows to hit to the standard bell-shaped curve, but it's still, it's just an average. Another version of benchmarking is, what does it take for me to be best in class? Like, what do I need to be aiming for to be best in class? That data is a lot harder to find in terms of what it takes to be best in class. So, you can kind of So what I'll tell you about that is that what we encourage our clients to do is to land, somewhere in the middle between average and best in class. And if you're not at average yet, at least push yourself to try to get to average. And then, every year try to make some incremental improvement, because, if you kind of think about the theory, the compounding effect, if you can improve, 1 or 2% a year, that makes a big difference in terms of, going from, a 15% EBITDA number, to a 20% EBITDA number. You improve 2% a year, suddenly you've gone from average to best in class, through a very thoughtful time frame. So when it comes down to benchmarking, budgeting and forecasting, I think our recommendation has always been, you got to start with, as the owners of the company, if you're not putting between your salary plus EBITDA, if that bottom line EBITDA percentage, including your owner pay and owner fringe benefits, if it isn't at least 10%, you got to ask yourself a question: what am I doing? And then once you get there, push for 15%. And then I think kind of the theoretical max that you can probably hit, in any of our companies, in any industry, is probably about 25%. Because when you go beyond 25%, then it means that you probably aren't scaling very effectively. Meaning, like, sure, you're at, 35%, but you're a $2 million company, when you could be a $20 million company. But at 25%, that 25% in absolute terms is way more than your, 30% at or 35% at 2 million. So at some point, I think our history has shown that 25% is kind of the theoretical maximum of any company, any industry. Doesn't matter what you are in terms of owner fringe benefits plus EBITDA. So I would kind of start there. And then when it comes to, so in terms of establishing a budget, you kind of start with, well, what do I want EBITDA to be in owner fringe benefits? And then, look at my existing cost structure and kind of build out, well, what would sales need to be to support that? And that's either going to tell you that you've got a realistic sales target. In other words, like, if you're like, well, geez, I'd have to have 400% sales growth. I've never done that before. You're like, geez, but instead, if it's like, 15% sales growth number, we've done that before. Maybe last year was 10%. We think we could do that again. Or you're right on the borderline, and you're like, well, it's more realistic that we'll get 10% sales. Let's start that. Then you would dive in and say, let me start looking at the cost structure. And just, I think at least once a year, people ought to really dig in and look at their cost structure and start challenging assumptions in terms of, like, why do we do that? Why do we need that? Are we as efficient as we could be? And what you end up finding by going through that exercise is that, it's sort of like, Superman 3, a lot of little eliminations add up to be a big, a big thing, when you're finally said and done. So what I'd recommend here is that it kind of gets into labor costs and overhead rates, is that once you go back and you just go back and you say, look, labor is a percentage of sales. Let's just go back and look at our history as to what that's been. All labor is a percentage of sales. What's that been historically? Has it been fluctuating over time? Is there a point in our history where it was better than it is today? What was different, and how do we get back there? Then really ask yourself, does my team really have the ability to either work, to do more because we've got capacity that they're not using, or alternatively to work more efficiently? Ultimately, you also have to take a look at your customers. In other words, and I'll give you a real world example from BGW, is that, we've got a client in one of our offices that, when you look at the hourly rate that we're charging that client, we're actually paying them to do their work. Meaning, like, when you look at the labor cost of the employee that is working on that work, relative to what we pay that employee, we're in the red. in terms of direct cost, which is just a kind of a legacy pricing problem that we inherited, that we're working our way through with the customer. But you also have to look at your customer base and what they're paying you, because it could be that your team is working highly efficiently, but at the same time, if Gary is willing to give me $1 for the same work that Timmy's willing to give me $2 for, I love Gary, but why would I continue with that? you know, like that should be a conscious decision, that the answer isn't just, Sally, you need to work harder, for us to hit this number. I mean, you have to throw customer profitability into the mix. So what I always recommend doing is, again, to kind of close the loop on this, you got to first off look at, what are you making? And is that kind of sufficient? Then back into, all right, let's really take a deep dive into my cost structure and what can I do without? What have we let kind of get out of control? And ask ourselves, if we've had a better point in our history, what's it going to take to get back to that history? And then lastly, you also have to look at your customer profitability to see if you've underpriced stuff. And remember, in a lot of cases, underpriced could be, I've had scope creep. I've done a bunch of change orders that I haven't billed for because I don't have controls around those change orders. So let me take a look at those as well. But what I've found is that most clients that we have, that are feeling pretty happy with how they're doing, if I ask them, so you telling me that you really don't have any rework, you don't have any places where you had a scope change that you didn't bill for, and you don't have anybody that you're getting about 50% productivity out of them. You don't have any customers that if you had the opportunity to reprice the work today, it'd be significantly higher than what you're doing it for. The answer to that is typically no. And when you add all those things up, it could be, depending on the size of the company, it could be millions. It's a lot of little things that add up to a very big number. So then you get back to, okay, that's cool. That's extra cash flow this year. But if you multiply that times 5, which is the value of your company, that's pretty significant value increase that you got by going through, maybe a 2 to 3 day exercise to figure out where you're at and what you can do to improve it. And then, kind of doing the hard work to get there.
Good. You want to hit any of those other ones that are still up there?
Yeah. So to get super specific on, labor costs and overhead costs, when I mentioned labor as a percentage of sales, it's simply just saying, just pick a number, whether it's actual salary or it's all labor overhead, including health insurance. I mean, it doesn't really matter as long as your measurement is consistent. If historically that's been 25% for you and now it's 30%, you just need to ask yourself, why is that? Do I have a good reason for that? Just so that you've got an answer for yourself, and then you just try to manage and control it from there. When somebody comes up to you and says, here's what I'm trying, I need 20 more people, what's that going to do to your labor percentage, just to see if you model that out and see if it makes sense for you, based on where you historically been. It's one of the places where looking in the rearview mirror actually can give you some good information about what your future might have in store for you. Overhead costs, same sort of thing, just running them as a percentage of sales, knowing that eventually they should kind of fix in at an absolute number, because a lot of overhead costs are not variable based on sales. They're fixed variable, meaning, rent is rent until I need more space. Then it steps up.
All right, good. All right, I'm going to launch another poll. Let's do, how about some demystification of tax strategies? Let's launch this one. All right. Go ahead and rock and roll, people. I'm anxious to see what has the greatest interest for y'all. Can y'all see it? Yep. All right. We got voting going on. Okay. While we're waiting for everybody to vote and while the votes are coming in, Robert Mayetta, good to see you here. Here's a good question from Robert. China's locked down several large cities this week due to COVID. How this will impact the supply chain and make it worse. Suggestions on how to prepare for this. Any thoughts?
You know, we've had, you know, other than just making sure you got sufficient working capital, your banking relationships are in place, you know, pretty well. I think we've had some questions before about, you know, boning up on inventory, and, you know, so that could be a strategy for you, but you know, knowing that you're going to have a longer lead time, you know, advising your customers to get orders in, you know, early, you know, just in the event that you're going to have that. But, you know, you got to balance that against inventory obsolescence. You know, I mean, it's funny, but it's not funny. You know, we've got a few clients that were in the PPE business that are sitting on a lot of face masks, you know, a lot of hand sanitizer right now. I mean, like lots, you know, hundreds of thousands of dollars that they bulked up because, you know, it's not the end of the world. I mean, they got a premium for a lot of those things when the market was pretty hot. So it's just something you got to balance in terms of just evaluating your obsolescence risk as you're brushing up, or as you're boning up potentially.
All right, I'm going to go ahead and share the results. We got a tie on a couple of these. Can you see it, Adam?
Yeah, I got you. Oh, it's gonna be tough. So how do I avoid paying taxes like the big companies? So good question there. The answer is a lot of cash and a lot of patience. And also, when you start hearing about the corporate minimum tax, you know, and doing something around that this is what they're talking about. So in our backyard, not in Steamboat Strings, but in North Carolina, Duke Energy has not paid income taxes for quite some time, and they won't pay income taxes for quite some time. So why is that? Well, it's a combination of things. In Duke Energy's case, they buy a bunch of equipment and they get depreciation. So that is available to all of y'all, is you could just buy a bunch of stuff and get depreciation on it. You know, that's ultimately just a timing difference, you know, and in Duke's case, they're big, you know, it's big equipment with a lot of depreciation expense. So, you know, they have federal taxable income, you know, that's that, and they're able to immediately depreciate and expense stuff, which is completely different from the accounting income that they report to the SEC, because, you know, I build, you know, a $4 bajillion solar panel array. I can expense that in the current year for tax purposes, but that's over 15 years for the accounting profit that I report to the SEC. So that's way number one that is available to everybody. Way number two are tax credits. So with tax credits, you know, in Duke's case, you know, they get credits for producing, you know, energy efficient power that may be available to some people on the call, but probably not. But you do have some credits that are available to you. You've got the ERC credit that was part of the stimulus package. If you're in the restaurant business, you got the FICA tip credit. If you're hiring people that are of certain work classes, you've got work opportunity tax credits. If you've got some aspect of research and development, which is a pretty broad category that applies to a lot of people, you've got some R&D credits that are available. So the second place to dig in terms of not having to pay taxes like a big company is just to, you know, make sure that you're digging in based on the attributes of your company, getting every credit that you could possibly be due. So that's the basics that are available to everybody. From there, you start to get into a little bit of the exotics, which will touch a little bit into the cash line around best ways to avoid taxes. So so if you separate out Duke Energy for an example and go to a company like Salesforce.com, or another big kind of startup company that's not paying taxes and probably won't, for a long time. And in both Salesforce and Duke Energy's cases, I mean, it's like, dozens of years. In Duke's case, it's actually 50 years. If they just had the same accounting profit they've had, doubled it, paid taxes on it, it would take 50 years for them to defer or to pay off or to burn through all the stored up, tax sheltering that we've given them through the tax code, perfectly legal. But effectively is an interest-free loan that we're giving Duke Energy and Salesforce and everybody else. So the other way that you can get the benefit of a tax deduction are stock options to your employees. So through a feature in the tax code, if I give Gary, some stock options that are worth a lot, but he hasn't had the ability to exercise them, I get the best of both worlds. I get the tax deduction for the compensation expense associated with those stock options, but I don't actually have to have that take a hit in totality to my accounting profit. So I look great for the SEC, bad for the tax man. So if you look at a company like Salesforce.com, why aren't they paying taxes? Well, way number one are all these executive stock option incentives that they've taken tax deductions for. Their employees don't quite have the right to yet and haven't exercised yet. And they're not reporting yet as SEC accounting profit yet. So they're looking good on both pictures, not paying taxes, but having great book income for their investors. Then Salesforce.com also has the R&D credit, which I talked about before. So, big company move number one that small companies typically do not do are going to be anything around, tax advantaged, stock option or incentive plans for your employees. That's number one. Number two is if you look at, that's one that you just got to get comfortable that internal succession is kind of the way that you want to go and you want to figure out how to get a deduction out of it. Number two, which is more of a patience factor that could go away with some of the proposed tax legislation in terms of corporate minimum tax. But if you also look at Salesforce.com, you also look at Nike. What they do is they set up a company in a foreign jurisdiction and they put all their patents and trademarks there. This is another thing you can do if you had extra cash, by the way, for that last question. They put all their patents and trademarks in that foreign jurisdiction and then pay a royalty fee from the US entity to the foreign entity. So they get a deduction for US tax purposes, but for book accounting purposes, it's right hand, left hand. I get to eliminate those transactions. So we really get to see what Nike makes globally. But for US purposes, they're not paying taxes. Now, the patient strategy on that is if Nike would like its money back in the US, it's got to pay a repatriation tax. And there are starting to be some minimum taxes on, extra cash sitting on balance sheets for companies that have come out as the last tax code change. But those are pretty significant dollars that if you just, I don't know the stats off the top of my head, but if you look at domestic based companies with cash sitting overseas, they haven't repatriated, it's like, excuse me, trillions of dollars, multiply that times the tax rate, you got the deferred tax amount that's sitting off that. I mean, that's one of the few revenue raising things that happened with the Trump tax legislation that happened is they allowed companies to do kind of a one-time repatriation at a lower rate. Reagan did it too back in his day, to repatriate some cash and get it, taxed in the US at a lower rate. So that's another way that big companies do all the time. The last thing that you can do with extra cash lying around is that, our favorite go-to moves, after I've deducted all my own fringe benefits is that, you could there are differing levels of retirement plans that are available, and the super duper high end retirement plan is basically the equivalent of an old school pension plan. I mean, the technical term for it is a defined benefit plan or cash balance plan, but it's basically where I say, Gary, you're awesome. I'm gonna guarantee that when you retire, I'm gonna give you $1 million, and I'm gonna just start saving money off for you. Well, that's a tax deduction for me as the company, not taxable income to Gary as the employer, as the owner of the company. So that's another biggie that's available to our small business customers that big companies do as well.
All right, good. Bruce, good to see you here. Thank you you always bring good questions too. I think you're giving Robert Mayette a run for his money. But here's the question, Adam. So when governments revert to gimmicks like eliminating payroll taxes or business use taxes for a period of time, but the companies and or individuals who benefited from the deferral immediately declare bankruptcy when the tax liability is restored, where do governments stand in line for the settlement? Are they first in line to be paid in full, or do they outlast other claimants who need some settlement quickly?
Oh boy, that's a good question. So I don't know the answer to that off the top of my head, but well, sorry. So my best guess answer, which I think is correct, is that when you look at payroll taxes in general, and you break them up into two categories: the trust taxes, which are withholding the employee portion of the Social Security taxes. The trust taxes are going to be first in line pretty much every time. Good luck with that, and you don't get them discharged in bankruptcy either when that happens. So that just means they're going to come first. They don't get discharged in bankruptcy. Liens are going on houses. It's just bad for the person. You see those commercials for Optima tax relief. And they, the people that are on Optima tax relief as the customer always look at like they're in a Caribbean location talking about how they got out of all these payroll taxes due to negotiated settlement. I have never seen that happen. I mean, you've got to be near death, something horrible happened with no ability to earn income ever again. That's way number one that I've seen people get out of trust taxes. So it's got to be real bad. So people that I know that have tried, those tax relief places have not. I mean, they basically just forked over some money and then got nothing for it. So if you want to try that route, you can. I don't recommend it. Route number two is you basically go on the lam, and by on the lam meaning you change banks frequently. Again, I don't recommend this, but it's a way to do it. You change banks frequently, and so the IRS has trouble finding you. And if you wait long enough, which I think the statute of limitation is either 7 or 10 years on trust taxes, eventually the IRS will just give up on you. But it means that you're basically operating out of the shadows to get out of the debt. Otherwise, I would just get on a payment plan with the IRS and try to, work it off, at that level. So then when you get to route number two, which is the employer taxes, which would be use taxes and the employer portion of FICA, I believe those can be discharged in bankruptcy, and in priority order, I would think that it probably is going to go employee back pay, lien holders, then whatever would normally happen, because those are considered unsecured credit obligations. So that's my best guess, Bruce.
Great question.
Yeah, I get
That's
asked
why
that
you're on.
when Jack's not here. Yeah, I get asked that when Jack's not here.
Okay, so Jack is here. He is drinking green beer in front of a pub. He just sent me this photo.
Yeah, got it. Okay. Good for him.
Oh my goodness. Yeah, he was able to get away. All right, so I'm going to take us to getting every credit due. And then I've got a fun poll that we're going to wrap up with after this one. Okay, getting every credit due. Go ahead and hit those voting buttons. What's funny is, given the day that it is today, it is St. Patrick's Day. And yet there's nobody voting for green credits.
Good, because that's the one that I actually know the least about. So, I mean, I know enough to be dangerous, but they change pretty frequently.
All right, cool. Well, there's a runaway winner here on employee benefit credits. So I'm going to go ahead and share the results with y'all.
Yeah. So on employee benefit credits, you've got a couple that sit here. The first one is just pandemic relief. So that's on the pandemic relief side. You've got the everything that kind of fell under, I think it's called the FFCRA, but it's everything that falls under kind of the category of the Family Medical Leave Act, which is basically, Gary, I'm going to give you some paid time off to care for the elderly, the people in your household that were sick. I'm going to give you some paid time off to care for your kid that got COVID and couldn't go to school, or otherwise, you had no other option, to get them through, a period of time. I'm going to give you some paid time off to go get tested, get vaccinated, whatever. So those are credits associated with, I gave people paid time off, didn't make them take sick days to do stuff related to the pandemic that is fairly broad, but is kind of what doesn't qualify under this. I mean, I suppose you could try to take it, but I would have a different policy. Is I'm just afraid to come into the office and I refuse to work. I mean, that it's not really what this is supposed to be targeted towards, but that also could be an area. But that's the one that's available associated with the pandemic. What you do with what you should have been doing with that one, and if you didn't do it, you would go back to your payroll company and say, hey, I need to look into this. Is that in 2020 and 2021, that should have been a credit applied to payroll taxes that you need to remit with your tax returns. And most payroll companies had a separate time code where you could report how much wages qualified under that category. Category number 2 is stuff that's been around for a while. I'm going to get the limits wrong on this, but I'm going to be directionally correct. So for retirement plans and health insurance, if you're a smaller employer and there's a revenue size associated with the small employer, I believe, that is pretty low. And then there's a wage component too of this. You get, which I think the wage is like $50,000 that you pay somebody. For anybody below that, you get a tax credit for, and I want to say it's like $500. I mean, it's not insignificant. You get a tax credit for having them be in your retirement plan or your health insurance plan. So it's a good way to be able to offset the expense to you for providing the benefit for your employees. So those are the big kind of 2 categories that exist. One pandemic related, the other one related to smaller company employee health insurance and retirement planning. And instead, those are really size restricted from the company perspective, and then wage restricted from the employee perspective.
Cool. Anything else you want to elaborate on that topic?
Yeah, I'll hit the job and employment credits because this is a pretty important one. So if you are, if it's super easy to do, or it's super easy to, post out to participants, Gary, or whatever. I mean, we did a video on each one of the work opportunity credits that's available to people. But so, it's certain classes of people. So veterans that have been unemployed, felons that have been unemployed, people that have been on, food stamps that or other aid that you now give a job to. So, it's some good categories, and they're pretty valuable credits. I mean, it's a lot, in terms of what you could get. I want to, pretty significant in terms of helping offset the pay associated with some of these folks. But there's one key. The key is, this is a two-sided process. Like, you have to document and apply for these credits in the hiring. Like, they show up on your corporate tax return, and then ultimately your personal return if you're a flow-through entity. But you have to fill out the forms associated with establishing the credit, as the person is being hired. Like, you don't go back. Like, this is one of those weird ones where you don't get to go backwards and say, oh wow, I didn't know that existed. Let me go back and just, do the analysis, and oh my gosh, I've got all these people. Because the whole idea here is you're supposed to be targeting these people as part of your hiring process, and you get a credit for doing so, instead of retroactively fitting a fact pattern, based on something. So, if you think that if you kind of survey your workforce and you say, wow, that kind of is what my employee workforce looks at, you may have lost out on some earlier credits. But at the same time, you can insert this in your hiring process. Just ask a few clarifying questions to somebody, and if they trigger hey, this person could qualify for credit, you want to go ding 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 ding, let me go apply for it. I don't really know kind of what are going to be appropriate HR questions to be able to ask if somebody qualifies or not. But we're members of the Employers Association. They're a valuable resource to us and our clients. I would think they might have something in terms of, all right, what's okay to ask versus what's not okay to ask, in terms of establishing the employment credit. I mean,
So
some
another
states
one-
will also offer state incentives for wages, but generally those are going to be pretty significant job creation type things.
One more that I'll mention, and if you guys want to learn more, I can connect you with Dan Flaherty of Mountain West Consulting. But he cracked the code. He has an organization that does fractional sales, like a VP of sales. And he works with small, medium-sized companies, but he was like the head of global sales for GE for one of their divisions. But what he found was that there are tax credits for training that basically fund his his program, which is pretty cool. And he's seen really, really great results, and it's based on county, I think, but where you're domiciled. So if you guys are interested in that, or if you know Dan Flaherty, just reach out to him. But if you don't know him and you want a connection, just let me know. I'm at gfrey@trustbgw.com, gfrey@trustbgw.com, and I'll help you connect to him too. So the last question, so that Adam can get those snow boots and snow pants on. He's got, bright green neon snow pants from what I hear. Just kidding. So here is the last question of the day. Are you interested in having us do a session on confessions of a former IRS agent? And we actually know one. It's actually a colleague of Jack Santignello. So, all right, well, that's 10 of 10. All right, so yes, I'm going to take a screenshot of this because I've got to, I got to be able to show this to Mr. Santignello. Just in case my screenshot didn't work, I'm going to take it here. All right, awesome. So 100% said yes, confessions of an IRS agent. We will tee that up and see what we can do to make that happen. And if we can make it happen next week, we'll do it. If not, it'll be coming up soon. Another one that I want to tee up is as well is a group named Jay Galt, and they have a program that's pretty reasonable, I think, for being able to bolster your company credit report and your credit score versus personal. You know, that's always this interesting balance of going from where you're personally guaranteeing everything to where you can get off of those personal guarantees and your company has the credit worthiness and the credit scores that the banks will pay attention to. Plus, they also do an annual company valuation as part of that, which is pretty cool. So we'll get those guys teed up at some point here too. But, you know, we're still in busy season. 3/15 just ended with corporate filing deadlines. We got 4/15 rocking up. So thank you for joining us. Thank you for putting up with 2 years of this. It's been fun. Adam, thank you so much to you and your family for delaying the start of being on the slopes at Steamboat, but enjoy your time and stay safe.
Sure, Gary. Thanks a lot. And thanks for everybody for being on.
All right. See you guys. Have a great day.
All right. See ya.